Good afternoon, everybody. Welcome back to Hurdle Rate. For this video, we're going to do a DCF valuation model for Apple. And I'm sure Apple is probably, for many of you, the largest holding in your portfolio. So let's have a deep dive into the numbers and see what we can get as a fair value. As you can see on the right here on the chart, Apple's currently trading at an all-time high. It's rallied quite a bit recently, going from, I guess, the tariff low of 188 up to 264. And it's had a fair few 20-25% pullbacks over the last few years, but it always seems to come back up. So let's have a look and see what we can find. So go onto the SEC website. We need the latest search for Apple under company name, and then we need the latest 10Q. And the latest 10K. The 10Q is a quarterly report, and the 10K is the annual report. So here it is here. So if we open those two up, I've got them here. This one is, I think it's the 10K. Let's just come down. We want to get to the revenues page. So it gives a very good breakdown of regional revenues, but we want to look at the products and services performance. So the revenue segments we want to use are for each, so for each product: iPhone, Mac, iPad, wearables, home and accessories, and then the last one, services. And we find the same on the 10Q as well. So yeah, let's get started. I've already freezed my first pane here, so let's insert another column before that, to have this here so that when we scroll, this always stays fixed. Go view, and you go, where is it? Window, go freeze first column. So make your A smaller. Oh, I haven't got rid of my grid lines yet. There we go. And in A1, just put AAPL. That's Apple's ticker. And go data, stocks. Come on, Apple Inc., Apple, there we are. I'll zoom in a bit too. There we go. So we start with our assumptions. Actually, we'll just fill in we want the ticker, we want the date. This is just a bit of admin so that when we come back to it, we know when we did these numbers, basically. So just format this number. No, sorry. Let's go fill first. We want with ticker, you go equals A1 dot, open the parentheses, and we want the ticker. There we go. The date is the 21st of the 10th, 2025. The current price, we go equals A1 dot, open the parentheses, price. And these two we can leave because we don't have them yet. In this, in the A column, just put in a little X and center it. And highlight up to L. Go fill. There we go. We want to go assumptions. So revenue segment, we're going to put what we see here: iPhone, Mac, iPad, wearables, home and accessories, and services. In this column, we're going to create our switches, and our switches are going to help us simulate between a bear case, a bull case, and a base case scenario. So we take this formatting, just pull it down, copy it. Copy it over 3 times. Here we will say bear, here base, and then bull. And if you could put 2s in the switch cell, because this is what will keep it on the base case. Once we use the offset function, which I will show you how to use later, we can toggle between 1, 2, 3 to simulate the different scenarios, and they will correspond to the relevant column here. So we'll get to that a bit later, but that's important to have. Below the revenue, we're going to have EBIT, then WACC, and then the terminal growth value. Then just copy these two, the WACC and the TGV, and just paste them here. Copy as so. Then these two, leave these two blank, don't put a 2 in here, and you'll see why later. Because this is going to tell us what our WACC is, depending on the scenario that we're simulating. Now let's jump straight into the revenue build. So make the cell equal to where it's got iPhone. Below that, we go percentage growth. Italicize that. Then we want a bear, base, bull. Just indent these. So the years we're going to be starting in 2022. So go there, 2022 plus 1. And now you can just copy all of this over to where we need to be. We're only going to 26, 27, 20, yeah. We're only going to be up to 2030. So remove 2021. That means I can zoom in a bit more for you. And now, yeah, there we have it. Let's start filling these out. So in 2022, iPhone sales were 205.5 billion, basically. These are in millions. So when you see it like this, it's not $205,489. It's $205,489,000,000. And you just have to check, because for the larger companies, they will note in millions. For the smaller ones, they'll do it in thousands. Let's do a bit of formatting, because we want it to look neat. We want it to look presentable. There we go. And then 2023 to 0583. So it's quite a big drop there. 183 minus 1. No, actually, just let's format this first. Then, yeah, then control copy. And just pull it along. This one will definitely, I always forget to do this one, but we'll definitely do this when we've done this total, because it's always interesting to see for Apple, see how much of revenue the iPhone is responsible for. So we'll do 2025 in a second, but actually no, let's do it now, because I'm going to pull it. I'm going to copy paste it over to make it easier. So 9 months ended 160,561 billion. Yeah. So we want to know. So for the full year of 2024, they did just over 200 billion. By the 9 months of 2024, they've done 154,961. So let's see what that ratio is. 154,961. So 1.298. So we'll do 160,561 multiplied by 1.2982815. So yeah, I mean, we're expecting significantly more iPhone growth this year, and especially as they just reported that the iPhone 17 is doing very well at the moment in the first I guess, couple of weeks of trading. Okay, so what we want to do here, we go equals average, and this, let's just format this to percentage, 2 decimal places. So for next year, if it was 4% this year, we're taking an average of the last 3 years and we're getting 0.5%. I think it will actually do better than that. So let's do an average of just the last 2 years. 2023 was maybe not a good year because I don't think they had an iPhone release then, and people were probably waiting for the more with the Apple Intelligence. So yeah, it might not be truly reflective. So let's just go with the last 2 years. Then we'll forecast up here, let's say it gets to 5%. Make this cell equal to what you have up here, because if we change it up here, it will then change down here as well. Now, what we want to do is we want to forecast these next few years of growth. Actually, let's put it as 3%. I don't think we can be overly ambitious, especially as the last few years haven't hit that. So let's go with 3%. We go in this cell equals. We take the previous year, we minus, open brackets, the previous year minus the final year, close brackets, divided by, open brackets, the final year, so it says 2030, minus the previous year. Now, close brackets. What we want to do now is we're going to copy and paste this. So we need to make sure that it just dynamically adjusts to where we need it to. So we don't need to do anything with this one, not with this one. For this one, we want to lock in the column, but not the row. And then for here, we want to lock in the column and the row, because this will always be the same for each product segment that we simulate. And then this one, we want to keep the row, but we want these columns to adjust dynamically. So we put the $sign in front of that. When you put a $sign in front of the column or the row, as we've done here, it just means it locks it in, meaning when you copy paste, it will adjust, but we'll keep that specific, say, column or row. So let's go enter. And then we just go control copy, paste. So for the next few years, this is roughly what we'll, if we see iPhones coming back up to 3% growth rate annually, which is not impossible when you think there's the upgrade cycles, Apple Intelligence, there could be a new reason for people to buy the new phone sooner. So yeah, let's go with that. Then here we'll put, I think there's a wide margin of error here. So if the base is worse than we think, let's put it at 90% of what we think the base is. Then for the bullish case, let's go with 110. So equals the base multiplied by the, in this situation, the bear. Lock it in because we're going to copy it all the way along here, and we want it to dynamically update as it's done there. Then down here, we do exactly the same. G20, so the base multiplied by the bull, and there we are. There we have it. Now, this is the offset. We're going to use the offset function that I mentioned earlier. So in this cell, we say equal offset. We then put the cell that we're in. So in this case, for me, it's G26. Where the growth rate is, it has to be there. Then comma, the switch that we're using, and lock in the switch because we want that to stay the same. Then comma, 0. And we go enter. And this basically corresponds to what's in here. So we could put this to, I mean, you can't see it now because of it's only to one decimal place, but I'll pull this over. Then let's simulate the, well, let's forecast the growth. To do that, we take the previous year multiplied by 1 plus the growth rate. Pull it across. Now, if I come up here, so remember these figures, 212, 217, 222. If we go on a bear case scenario, it comes down. If we go on a bull case, it goes up. So yeah, so that's what we're going to do with all of the product segments, so that we can think, oh, 1 year, oh, we're actually quite bullish on the iPhone. The next year we'll be like, oh no, I don't think Mac sales will be that good. So we can toggle with these switches and help us simulate different scenarios of where we think the company is heading. So we've done the iPhone. Let's do the next one. Just copy and paste this. And we have to just do a lot of correcting because it's not going to copy it directly. Well, it won't adjust it properly for us, so we have to fix that. So Mac. Here again, we're going to put this as 90% and 110. We don't know yet, so let's fill in the figures. So yeah, 40 billion in 2022. 40,177. Then 29,357. 29,984. Then for 2025. So yeah, so for 2024 they had done 22 billion and finished on 29. So let's see what that comes out as. 1.3 about 1.35 equals 24982. Oh, so that's doing quite well. 12% last year. Well, for this year, it'll be a 12% growth. Let's say that settles at 5%. What is it, G11? Yeah. And just change these to 11. Make sure you copy it over, otherwise it won't correspond with the correct switch. It will stay on this switch. So when you flick the iPhone switch, it will also flick here if you haven't copied it over to 11, so E11 rather than E10 for Mac. Yeah, okay, that looks good. Do we think 5% is a bit high? 45 billion. That's 12 billion more than now in 5 years. Okay, let's go 4. Next one is the iPad. Equals B12. Okay, 29. What is that? 29,292. 28,300. 26,694. 26,694. Then for let's do 26,694 divided by 19,744, 1.35. So it all seems to be about the, I mean, I guess it's obvious that they would do better in the last quarter of the year because of Christmas. I think we can leave that at 0%. It's difficult to see the iPad having, say, exceptional growth. And for here, for the bear case, we have to put it as what would, yeah, we would go, well, it can't, is this, that would end up just being, oh no, we can, sorry, we can, my bad. Pull it across. And this should be C12. Also, just update this one from C10 to C11. Pull it across. There we go. Looking good. Next one, wearables. I think it's B13. Yeah. Oh, yeah. 40. 41, 241, 39845, 37005. Oh, so these are actually decreasing. I always thought the wearables were going up. Divided by 26,673. Nope, sorry, I've done that wrong. It'd be 27,963. So 26,673, 26,673 multiplied by 1.32335586. Okay. Okay, well, I mean, these are decreasing. I mean, I get the HomePod probably wasn't very popular, but I thought the watch and the AirPods were doing significantly, well, I mean, it's still a $35 billion revenue segment, but still, I thought it would be growing rather than decreasing, especially as certainly for AirPods, you need to get them every couple of years. So again, okay, let's go with 0% revenue growth there. And that's G13. But instead of, this needs to be 110 because it's on negative numbers. So we need to reverse it, because if we'd gone on 90%, it would be, I mean, yeah, having negative 6.6% growth rate is not a bull case, so it has to be reversed. Just update that to, there we go, same down here. Pull it across and change to 13. Pull it across. Very good. Then the final one, services. I mean, this is incredible. Look at that, 78, 129, 85, 200, 96169. See here, services. So 70, and it looks like it will do really well this year. I mean, we all have those, like, you know, $3 fees every month to Apple, and this is what it amounts to. No, sorry, I've done that wrong again. 71, 197. This section, I think we can actually put quite a big growth rate on. 9713. I think we put 10% there. 14. G14. Yeah, looks good. Remember to change this to G. Okay. Now we can sum up our revenues. Order. And yeah, we'll definitely do these percentage of revenues because we want to see how each segment is changing, basically. How no. BC C46, so C39. There we go. So pull it across. Let's get that growth rate. Okay. Yeah, that looks good. So we're saying that over the next few years, it will start trending towards a 5% growth rate in revenue. Yeah, of course, let's work out what our percentage of revenue is. Format. So yeah, it's so iPhone's about 50% of sales. And services, this one we're expecting to become, almost, whoa, what is it doing? To become significantly more important. Yeah. It's very interesting. We're services, yeah, this is going to become such an important part of the revenue share. But iPad and wearables, I think it's getting weaker and weaker. Mac will probably stay quite stable. iPhone's becoming less, but I think that's because it's getting taken by the growth of the services. So yeah, there we have it. There's the revenue build. Let's move on to the income statement now. So let's copy our. I think this is a little bit smaller. Come down. Income statement. To go total revenue. No, just call it revenue. But make sure that you make it equal to, to what we've just calculated. Pull it across. And again, it might feel like there's a lot of repetition, but there is a meaning to it. We want these to be equal to this one because when we're simulating with the switches and getting different revenues and getting a different forecasted total revenues, we want it to dynamically link here because this will be linked to our free cash flow valuation. Free cash flow forecasts and ultimately the valuation. So EBIT, this is your operating income. We want to know what that is as a percentage of revenue. Where is it? We need to go down to the income statement now. And these sometimes are either at the very front or they're at the back. They're either at the top, or at the end. So operating income down, this is what we need. And on this page, yeah, so this one's, it looks like it's, where is it? Here we are. So this is your this is your cash flow statement. This is your balance sheet. Then the income statement is here. And this is what we need, operating income. So for 2022, they did 119,103. $113,736. So what am I doing? No, I did that wrong. It's, sorry, 119,437 for 2022, then 114,301, then 123,216. And we want to know what this is as a percentage of the revenue. So you take the EBIT, divide it by there, and then you divide it by the revenue, and then we get our percentage of revenue, and that's our EBIT margin. But yeah, I mean, this is huge, 32% on such a large company, and we'll talk about why that is the case in a second. But let's just do for 2025, 93,625. So 123,216 divided by 93,625. 100,623 multiplied by 1.31605874. There we go. Pull this along, and this is going to be our initial sort of loose EBIT forecast. Just take an average of the last 3 years, put it across, and then do your revenue multiplied by your EBIT margin. And we'll go into that a bit more once we've done the cash flow items as well. Percentage of EBIT. The provision for income taxes, this line here, 19. So they're paid in 22, 19 billion, 16,741, 2,9749. We want to know what the tax rate is when you divide it by your EBIT. Okay, 2025, where is it? Provision for income taxes. So equals 14,875. No, divided by 14,875. Oh wow, 15,381 multiplied by 1.99993277. Okay, and again we'll take the last 3 year average. You can just copy it from here and paste it here, and it will update using these 3 figures. Then we go take your EBIT and just multiply it by your tax rate, pull it across, and there we have it. There's our initial, they won't be our final figures though, because you'll see when we go on to the actual DCF, we're going to be able to simulate the EBIT. So now it's cash flow items. Now your cash flow items are depreciation and amortization, the CapEx, and your change in net working capital, or that change in NWC. And we want to know what that is as a percentage of revenue. So yeah, pretty much just from these 5 figures, is how you will calculate the unlevered free cash flow. So yeah, let's start filling these out. This one is, so come down to your cash flow statement. which is here. And on this one, usually the order goes income statement, balance sheet, cash flow statement. Sometimes they put the balance sheet first, then income statement, but usually the cash flow statement is at the end. So we want depreciation and amortization. CapEx is in this case, payments for acquisition of property, plant, and equipment. Then your what would it be? Yeah, then your change in net working capital is there's changes in operating assets and liabilities, and you just add up, you sum up all of these, and that gives you your change in net working capital. So yes, let's start filling them in. So 11,104. 11,519, 11,445. See what this is as a percentage. It's very tiny. Actually, no, 3% is quite a bit. Then, yeah, then your CapEx is 10,708. 10,959, 9,447. See what this is a percentage of revenue. Just see how much this is a percentage of CapEx as well. So, I mean, depreciation and amortization is outpacing the capital expenditures. Normally, you want them, well, obviously, to be about equal. Otherwise, all your, I guess, equipment will be useless if you don't keep repurchasing and updating it. So, equals DNA divided by 8534. 1.34, do 8571 multiplied by 1.3411. Okay. Do the same for CapEx. Equals 9447 divided by 6539. No, we want to now do 9473 multiplied by 1.4471. Okay, I mean, this is quite interesting because if you watch the meta video we did, and you'll see it when we do Google, Amazon, etc., CapEx for the Magnificent Seven is going towards like more than 30%, which is huge. And this means that, well, there's the advantage that Apple is asset light, so it doesn't have these huge expenditures that, say, Meta is going to have. But it does mean it will have to rely on its partner for that infrastructure, which I don't know. We'll have to see how that plays out. But if we're looking at, if I recall correctly, Meta it was something like 35% of its revenue. That's how large its capex expenditure was. So yeah, that's it's a huge amount. So to calculate the forward depreciation and amortization, we just copy this across. So it's average, copy it across, so say 3%, and we do our revenue multiplied by the percentage of revenue, and that gives us that amount. We just copy that across, copy the percentage of CapEx across, and that will fix. Then you can, again, just copy that, fill it down, and do your revenue multiplied by, there we go. Oh, I forgot to do change in net working capital. Let's do that now. So yeah, so as I said, the change in net working capital is the sum of these figures. In parentheses and brackets, that's a negative number. So we go equals sum minus 1823, comma minus 7520, comma 1484, comma, minus 6499 plus 9448 plus 6110. Oh, no, sorry, what have I done? I've done something a bit silly there. I'm not concentrating. Comma after each one. Is that right? Okay. We want to know what it is as a percentage of revenue. Okay. Equals sum minus 1688, 1271, minus 1618, minus 5684, minus 1889, plus 3031. And when change in net working capital is negative, it's actually good for free cash flow, because when you calculate your free cash flow, you add back in depreciation and amortization, you subtract your capex, and then you subtract your change in net working capital. So if this is negative, it's a double negative makes it positive, so you add it in, which is which is always good for free cash flow. Minus 3788, minus 1356, minus 1046, minus 11731, plus 6020, plus 15552. So this seems to change from year to year for Apple. Generally, when it's negative, it means that Apple will have, say, favorable terms with their suppliers that they can pretty much, well, also it's that they're almost getting paid before they deliver the product or have to pay for the product. So with this one, we'll just sum it together. It's only 1% of total revenue, so it's not as big it doesn't have as big an impact as 3 minus 6116 minus 18479 minus 15161. So you just comma after each. No, sorry, I've got this wrong. Equals sum 5685 13555 plus 1223 minus 6116 minus 18479 comma 15161. Yeah, okay, looks good. Now just take an average of these the last few years, pull this across, and just go revenue multiplied by. Oh, this is going to be really good for free cash flow. You can see it already. Let's move on to the DCF. And again, we've just got to just fill out all of these again, but you'll see why in a second. There we go. Now EBIT. We can actually put this yeah. Percentage of revenue. So copy this down to 2025, because they're the factual figures. Well, this is almost factual because it's nearly it's 3/4 of the way through the year. Then percentage of revenue as there we go. You can copy this straight. We'll do an average of the last 3 years for this one. I'm gonna say it's gonna maintain that 32% margin. I don't think it can go much higher than that. So we'll say 105%. But we'll keep the bear case as being 90. So what is that? G16. Here again, offset. The cell that we're in, G93, lock in, but C16, comma 0. Then we do multiplied, the revenue multiplied by the EBIT margin to forecast what it's going to be over the next few years. So yeah, that looks good. And this, now we've set up our switch so we can toggle with the EBIT margin, with the EBIT revenue, sorry, or the EBIT generated. Let's go taxes, percentage of EBIT. Okay, again, make this equal to what we did up to 2025. Pull it across. Then we just go equals average, take the last 3 years, pull that across, and make sure it's connected to this one, the EBIT multiplied by the tax rate. Pull that across, and now the tax payments will go up and down depending on which switch you use. I can show you. So we see this is, okay, look at this one, 132935 for EBIT, 27482. That's a base case scenario. We just go 3, put it into a bull case, and it's increased. See, 15813935881. So yeah, that's why we do that. And the DCF is very, very sensitive to the EBIT margin. A slight movement in it changes the price rapidly. Now under this, just draw a border. We're going to calculate the EBIT, which is your earnings before interest, but after tax. And that's quite simply your EBIT, and you subtract the taxes. Bold it, pull it along. There we go. Now we want DNA here. Now we're going to calculate our free cash flow, our unlevered free cash flow. So pull in our there we go. Pull it across. Okay, I'm just going to take this formatting. No. Sorry, I was trying to be fast. There we go. Now we want to calculate our unlevered free cash flow. No, this didn't copy. Why didn't it copy? Come. What's wrong with No, okay. There we have it. So unlevered free cash flow, we calculate that by taking our EBIT, the earnings before interest but after tax, and we add back in depreciation and amortization because it is a non-cash expense. We subtract capex, which is obviously an outgoing, and we subtract the change in net working capital. Because this is negative, as we said earlier, it's going to become positive. So even though the EBIT was 105 billion, the unlevered free cash flow that we're forecasting is nearly 114 billion. So there we have it. This is we're pretty much 3/4 of the way done. But now we have to find out the present value of the unlevered free cash flow generated. And to do that, we need to calculate a WACC, a weighted average cost of capital, which discounts these cash flows back to what they're worth today based on the risks that we foresee. So let's open up another sheet and let's start building out our WACC. So again, we're on a new sheet. As always, we take off the grid lines. We can make the A a bit smaller, the B larger, and I will show you now how to build out the WACC. Again, just put the ticket in the top in A1. Okay, so, and also just make sure that it's linked to the financial data. Select. Okay, so the WACC, the weighted average cost of capital, equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So we're now going to start filling out the components. Some of them we know already, it's quite easy. The others, like the cost of equity, we're going to have to calculate that. So let's do it. First one we go for, we want the market cap. And this is, we just go equals A1 dot, open the parentheses, market cap, but divide by 1 million, because that's what we're working with on the sheets. So yeah, Apple here is just under a $4 trillion company. We want percentage of equity, cost of equity, then risk-free rate, the beta. What's after that one? It's the equity risk premium. And if you've watched the previous ones before, we know that the risk-free rate, the beta, and the equity risk premium make up the cost of equity. So just so that we know that, let's indent those. Then we want indent back the debt. No, not like that. Debt, percentage of debt, the cost of debt. Why does it keep doing this? There we go. Debt, cost of debt, tax rate. And below tax rate, we say total. I'll zoom in a bit more if you guys need. Then we have WACC. Now, we know the debt because we can go onto the balance sheet and find it there. So debt, we want this one, 82,430 plus 9,345. So yeah, we'll just do these term debts, 82,430, 9,345. We won't do the commercial paper because it's very short term, and I don't know if it's necessarily interest bearing. But yeah, we'll just do where it says term debt, 82,430 plus 9,345. So 91 billion of Yeah, looks good. We want total here. So in total, it's for just over 4 trillion, which means your percentage of equity is on 97%. Your percentage of debt. Imagine that, having 90 billion in debt, but it's only being 2% of the total. Yeah, crazy. Then what can we do? So the tax rate, let's see if we can just find that quickly. It's never quick to find the tax rate on here. Where's those income taxes is where we'll... Oh yeah, the commercial paper. Where is it? Income taxes. Okay, effective tax rate, 9 months ended 15.4. The cost of debt, did we see it at the top there? Okay, it doesn't say, so let's just, we take the because we should have other income expense. So yeah, I think 698 multiplied that by, say, 1.3. No, divided by 3 times 4, and we should get our annual interest expense. 698 divided by 3 multiplied by 4. So 930. 930.666687 divided by your debt, like a 1% interest rate. I mean, does it still have its AAA rating, Apple? I'm not sure. Okay, now let's move on to the cost of equity. The first thing we can look for is US 10-year. Where is it? Bonds. I mean, we know it's dipping. Okay, 3.955. 3.955%. The beta, the way we're going to do this now is we will pull up our total beta spreadsheet. Wait, come. There we are. We'll say that Apple is... We'll go electronics general for the hardware. And then software and system and application for the services part of it. Yeah, let's do that. Okay, so to work out the beta, what we have to do is we have to look at, not just because Apple is, for a long time, was like 10% of the S&P. So when Apple moved up, the S&P would move up. So it didn't give you a full understanding of how it moves to, because it's not giving you a full it's not giving you a full understanding of how it's moving, I guess, relative to the market when it's most of the index. So what we do is we compare it with other companies where it generates its revenues from. So we can say So yes, so we'll go software, system, and application for the services, and then then electronics for I think general is fine. So what we do for the beta, we take industry, then we look at what the unlevered beta is. We look at what the revenues for that specific bit of it is. We then look at the EV to sales, which helps us find the value of that part of the company. We take the weight, and with that we can then calculate a weighted beta. So what did we say? We said electronics and software, system, and app. So for those two, electronics, it's 1.36. Yeah, 1.36. Software, 1.31. The revenues for these are for electronics, it's going to be iPhone plus the Mac plus the iPad plus the wearables. And the services is for the software and system. Now for the EV to sales, we don't need this sheet anymore. We want our price to sales. We need this column. .72 and 11.54. So the value of the electronics part, we would say is you multiply that by the EV to sales, and we get 220 billion. Then we do the same for this this for the services bit. We sum those up, and now we want to work out what the weight is. Yeah, I locked it in. There we go. Now you just take your unlevered beta, multiply it by the weight, and there we have it. The beta for Apple, you just sum it up now, 1.32, which is pretty much where it was anyway, equals H31. Now the equity risk premium, this is a bit more difficult. We need to come back onto the latest one. Let's see if they break it down, where they get their revenues from. Yeah, okay, this is good. No, I want the 2025 though. I think it was at the top, wasn't it? No, it wasn't. Here we are. This is what we want. So yeah, these numbers, and we'll... Okay, so we have Americas, Europe, Greater China, Japan, and the rest of APAC. We go revenues, ERP, weighted ERP. So for Americas, the sales were 134,161. Remember, this isn't annual sales. This is just this is just year to date of what they've reported. But all we're doing is we're just trying to find out where Apple gets its revenues from, so that we can assign a risk to that. Because normally, what a lot of people will do is they'll say, "Look, Apple's an American company. I'm just going to apply a US risk premium." But the fact that Apple is getting pretty much 50% of its revenue, or maybe even more, from outside of the US, there are risks to those revenues. So sorry, 4984,884,220,67. There are risks to those revenues, and they need to be factored in to give us a more accurate approach. So yeah, so for the Americas, we can just sum these as well. So to find the ERP, we come to our other spreadsheet. I'll just take this one off. Okay, so we could, if we could say use the 5.88%, but let's do the breakdown. Let's go North America to Central and South America. Okay. For Americas, we'll use this 4.58% because the majority of those revenues are going to be coming from the US and Canada. So we'll do that. Then Europe, is there a 5.43%. Greater China, 5.25%. Or Japan, again, 5.25%. And the rest of APAC, we'll use this in small Asia, 7.12%. And as you can see, if we'd just gone on a US risk premium, we would have put it as 4.61%. But as you can see, we have all of these ones. Let's calculate the weight, and then you'll see how it differs from if we just use that 4.61%. Some of these things, though, they're a bit hard to explain. It's better just to sort of to show, and then it can be quite easy to pick up. Let's just make sure this equals 1. Yeah, equals 1. So the weight of this ERP is, pull that down. This needs to be a percentage though. There we go. And we go equals sum 5.16. See, that's different to the 4.61% we would have got if we just used a US risk premium. 5.61% F39. $5.61. So now your cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. And that's what we're going to calculate now. So risk-free rate plus your beta multiplied by your equity risk premium. And there we have it. Nearly 11%. There we go. Okay. For the WACC, we're going to do this formula. So come down to your WACC box. and go equals percentage of equity multiplied by your cost of equity. And again, let's put these in brackets, plus your cost of debt multiplied by your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate, and double bracket at the end just because otherwise we're going to accept it. There we go. 10.53%. That's the WACC for Apple. So come back onto your other sheet now. Go here, equals the WACC. And your WACC is, so your bear case WACC is the 10.53 plus 0.5%. Column width. Just copy this over so it doesn't stretch the thing, and then going to be G17 and minus 0.5, because the lower the WACC, the more bullish it is. For the terminal growth value, we're going to use 2.5%, and this is fairly standard. For the bear, you minus 0.5%, and for the bull, you plus 0.5%. So we want to simulate now the switches for the different WACCs, but instead of using offset, we're going to use the choose function and just select all of these, but make sure they're in the right order. Yeah, that looks good. Just format it the same way. Copy paste, let it come down. And great, we've built out our WACC, and we can go into finding the present value of the unlevered free cash flow. Just insert another row up here, and above 2026 put 1. Then next to it, just 1, the cell plus 1, pull that along, and you're going to see why we do that in a second. So take your unlevered free cash flow, divided by 1 plus your WACC, lock your WACC in, close brackets, up to the power of 1. Just format it down, then pull along, and there we have it. That is the present value of the unlevered free cash flow. So that's what these are worth today, because this is 5 years out. Obviously, £1 today or $1 today is worth more than $1 tomorrow because of inflation and all the other risks associated with holding cash. So yeah, we have that. Now we want to find our terminal value. And that is, you take your final year of unlevered free cash flow multiplied by 1 plus the WACC divided by your WACC minus your terminal growth value. And it's coming in a second. Then we want the present value of the terminal value. There we have it. So the terminal value is just about 1.9 trillion. The present value of this is you take, again, the terminal value divided by 1 plus your WACC to the power 5. Of the final year. If your final year was 6, you would do it to the power of 6, but we usually do it in for 5 years out. If it's a high growth company, you try and do 10 years out, but forecasting 10 years out is a bit useless. Now we want the enterprise value. And this is just your sum of your present value of your terminal value and all of your present value of free cash flows that have been forecasted. So that is the enterprise value. Now we want to add cash, subtract debt to get the equity value. We know the debt because we have it on the WACC. And the cash is, come back onto the balance sheet. Here we are, 36,269. We're not going to, do we use that one? Yeah, okay, well, let's do, so 36,269 plus these marketable securities, because they can be converted into cash very quickly. Now the equity value is, you take your enterprise value, you add your cash back in, and you subtract your debt. So we have an equity value of about 1.5 trillion. Now we want to find the diluted shares outstanding. And this can give us our implied share price. And we already know, because if Apple is like a $4 trillion company, the fact that its equity value is 1.5 trillion, it will mean that, the share price is going to be a lot lower. So let's find out. Okay, this is what we want. So 15 diluted shares outstanding equals 15,051.726. That is reducing, so that's quite good. And the implied share price is $105. So let's have a look. Equals K124. So, I mean, theoretically, on a base case scenario, there is a minus 60% downside to Apple. If we go on the bullish, see what that can give us. Minus 52%. $84 on a worst case scenario. So let's go back to the base. So yeah, so 105, where could, I guess because we're not, I mean, the only thing we're really genuinely forecasting strong revenue growth on are services. The rest is it's either low growth or no growth or heading towards lower growth. The EBIT margin we're saying is going to be quite strong, but this will be 32%. It will maintain that. So yeah, I think it could just be a case that everything is a bit overvalued at the moment. That's why on all of these valuations that we're doing, we are seeing these 60% downside, because they are trading at very high multiples at the moment. So yeah, that's it for today. Yeah, thanks for watching, and we'll see you on the next one. I'll probably do Google next, or Alphabet. We'll do that later this week. Then thanks for watching, and don't forget to hit subscribe. Thank you very much. Bye.